The TSX Composite Index has been hitting new highs this year, and strength in some key commodities has a lot to do with that run. With U.S. copper tariffs looming, what's the outlook for the commodities complex? Joining us now to discuss, Hussein Aladina, Managing Director and Head of Commodities at TD Asset Management. Great to have you back on the program, Hussein.
Thanks for having me.
There is a lot going on right now, spotlights on the metal markets, considering everything that's happened. Where do we want to start? Do we want to start with this copper threat?
Yeah, sure. So for the better part of the year, there's been uncertainty around what the U.S. tariff on copper imports would look like around Section 232, which is something that was expected to have some closure later this year. Trump obviously last week made some waves, 50%, talking about 50% tariffs. You've seen U.S. copper prices year to date meaningfully outperform rest of world prices. That's resulted in a big pull of copper into the U.S. We calculate that the U.S. has probably imported somewhere in the 400,000 to 600,000 tons more than they need in advance of the tariff. We're actually quite sort of tactically bearish copper right now. We think that the pull from the U.S. will stop in the interim, and that will soften global balances at the same time that we anticipate some sort of seasonal weakness out of China. Doesn't challenge our sort of structurally very constructive view on copper and commodities broadly, but in the near term, anticipate some weakness in copper, which looks to be playing out.
I was going to think, if you're pulling forward that much demand ahead of an event, and then even if the event comes to pass and it's the worst case scenario, you've got your copper, right?
Yeah, and I think copper's a microcosm of this. I think there's been a lot of sort of front running of demand in anticipation of tariffs earlier this year. And I think broadly that can act as a bit of a sort of a depressant or headwind on commodities broadly. If I've brought forward demand, anticipate maybe some weakness over the course of the next couple of months.
You say longer term, still constructive on copper. Is this about the electrification, the ultimate end use of copper?
Absolutely. So there are global themes that I think are quite supportive of copper and commodity demand broadly, but the point that we're in the commodity cycle and the fact that over the course of the 10, 12 years into COVID, we discouraged commodity investment is tightening balances. I think that you're absolutely right that electrification is a theme, a mega theme arguably, that's going to support copper demand for 5, 10, 15, 20 years. But the fact that we've neglected the supply side is what makes it far more interesting. We have not looked for or incentivized copper producers for the better part of the last decade to look for supply. If I look at the supply growth actually that the copper market is seeing today, Greg, it's coming primarily from 3 projects that started in 2012 that were financed and incentivized in the last commodity cycle. So it's very much a demand story, and demand is expected to be very robust because of ChatGPT, because of electrification of the auto fleet, but it's very much a reflection of the fact that we haven't incentivized the search for the material.
Are any of those copper plants, I think you named 3, you talked about 3 of them there, within the territorial United States? Because I think the point of these tariffs are to ramp up domestic copper production, but from my understanding, they only produce about 50% of their needs.
Yeah, and you can relocate the Nike factory from Vietnam to the U.S. if the tariffs incentivize you to do that.
We don't get the shoes out of the ground, we make them.
And the problem is, yes, there is copper resource in the U.S., but it's not being developed in any meaningful way today. And even if we start making that investment today, we're talking about 7 to 10 years before you see an uptick in upstream copper production. So this policy I don't fully understand. And yeah, there is no readily available copper mines that are waiting to start.
Let's talk about gold, because another part of what we're seeing, obviously, if we talk about the TSX, I know you're not a stock guy, but we watch the TSX, we're saying the miners have played a big role because of copper, because of the run we've seen in gold. Was there a pull forward there too?
Yeah, so gold, we very much like gold and kind of remain overweight gold, and that thesis is very much a reflection of what we see happening, continuing to happen on the part of central banks globally. We've talked before about central bank reserves, particularly in the emerging market, are primarily housed in U.S. dollars. So if I look at, Germany's reserves, most of their reserves are in gold. If I look at Italy's reserves, most of their reserves are in gold. When I look at China, India, Indonesia, Malaysia, Poland, like the bulk of the world has their reserves sitting in U.S. dollars. And whether it's a de-dollarization theme on the heels of what's happening in the U.S. or otherwise, I think you're seeing continued interest from EM central banks to diversify their reserves away from fiat, away from the US dollar, towards gold, and we think that is a structural trend that continues to support gold pricing. Can I see gold price weakness on the heels of continued robust equity performance that discourages institutional and retail from holding gold? Absolutely. But structurally, gold trades higher.
Gold right now on my screen at $3,351 an ounce. You said continued strength. Would it be a lot of upside from here? Are you thinking this is sort of a range we're in now?
I think near term, it's quite possible that we trade in a range. I think we're going to continue to see arguably on the margin positive data on the trade front. I think that's going to continue to potentially favorably impact equities, potentially continue to see some strength in the dollar, which acts as a tailwind, as a headwind against gold. So near term, not expecting this thing to go to the moon, but on a sort of 3 to 5 year basis, I would not all be surprised to see gold at $4,000, $5,000 an ounce.
So how does that start playing out for the other metals? You start talking about platinum and silver. What are the fallout effects?
So if I look at the different sort of PGM, platinum group metals, and precious metals, platinum is up over 50% year to date. Palladium is up 30% year to date. Silver, I think, is up 27% year to date. Gold is up 25% year to date. I think you're seeing a bit of a catch up in the platinum palladium markets. Platinum has actually been in deficit for the last 3 years, and most forecasts call for continued deficit over the course of the next 3 to 5 years. I'm going to sound like a broken record. We haven't incentivized miners to go and look for platinum, palladium, copper, et cetera. And that's what's tightening up the supply side. We're seeing slightly better demand as well in the auto space, platinum, palladium used in catalytic converters. That's supporting this idea of deficit. Palladium is a little bit more balanced. The market, some are calling for deficits, small surpluses. So we think palladium maybe has moved a little bit too much in sympathy. But platinum, I don't think, is going back to $900,000 an ounce because this market remains in deficit for the foreseeable future.
With all of that in mind, how should investors be thinking about a portfolio and the role of commodities in a portfolio?
So, strong believer that strategically you want a portfolio that has an allocation of 5 to 10% commodities is better than a portfolio without, from a Sharpe perspective, from a drawdown perspective, and that is true over time. If we're right in where we are in the commodity cycle, commodity returns materially outperform through the investment phase of the cycle, which lasts 5, 7, 10 years. If you run that mean variance optimization, it's going to tell you want to have more than 10% commodities today. We're still recommending a 5 to 10% allocation in commodities if you're interested in improving the Sharpe, pushing out the efficient frontier, and cutting the drawdown in periods of drawdown. A portfolio with commodities has a shallower drawdown 80% of the time than a portfolio without, and that's going back to 1960.